Sorry, I can't stand behind the lectern. And also start with another apology. You were meant to be doing a tour this morning of the trading floor and the operational centre, and we cancelled that because it's quite a hot day and there's quite a lot going on. And we actually don't like our traders being disturbed as we're managing the market. Be careful how I phrase that. But if I look stressed, rest assured it's not because something's going on downstairs. It's, first of all, I've got to follow Andy, and Andy always sets a very high bar. And secondly, his ability to ask you questions on the spot makes you incredibly nervous. So the stress is more about being up here than what's happening on level 11. So quick start with apology. I think most of you know me. I run the wholesale group for AGL, which is basically the procurement of power for our customers, and that's power and gas and the renewables project. And it's going to be a very, very diverse portfolio. In this presentation, I'm going to cover a few things. First of all, some of the design issues. So we've gone from Andy's high-level visions for AGL and the business right down into some of the weeds of what's happening in our market live, but they're actually quite important to consider. One of the questions was, how do you invest given the level of uncertainty in the design of the market? So I'll cover off a couple of the key design factors that are going on now, noticeably the neg and the 5-minute market, because I know there's been a fair discussion out there about that. Then about bringing on new supply. Andy's talked about the 90-day plan. In this, we'll talk about our other investments we've committed to or in the process of committing to. And hopefully you can see why they make sense against some of those designs and some of the factors that are occurring in the market. And then Richard will try and do his version of a long-term perspective, not quite to the same standard as Andy, but talk about what we see in the market developing and talk about grid-scale batteries as they come in. But also the other factor, which is right at the customer end, which is what New Energy and Melissa's team is also looking at, is what are our customers going to do and how will that impact the type of wholesale investments AGL need to be looking at. That's a brief overview. So to dive a little bit into the weeds, the neg. The first thing about neg, and this is the one that got us straight away when the announcement is, we're going to impose a reliability standard on the market by 2019. That's actually a very, very fast time frame. So the instant thing, can we supply to that reliability standard given our portfolio? What I've put up here, first of all, is actually the market. So the total, not AGL, the total market. The little pink dots at the top are actually saying what capacity is available within state to supply that market. So what's dispatchable within the state? Not your renewables, not interconnectors, what's actually dispatchable in the state. The dark blue bar represents residential customer load on an extreme day. Think of the, not quite this day, but the 45-degree day, air conditioning's on, what are consumers consuming on that day? The light blue bar is the business load on that day. That also has some swings on those extreme days, but not as much as your residential load. And this is showing you how well each market is supplied. So New South Wales and Queensland, they've got adequate dispatchable load in their states to cover their load. You move to South Australia and Victoria, and interestingly, everyone talks about South Australia. Victoria's actually got a bigger shortfall than South Australia for dispatchable load in the state. Now, before you walk out of here and panic because the lights are going off on those really hot days, that doesn't account for the wind could be blowing, interconnectors flow. And the reason Victoria has a less of an issue is because Victoria is a very well interconnected state. So you've got the flow from New South Wales, you've got 500 from Tasmania, you actually backflow from South Australia. And on those really hot days, what you tend to find, the really hot day in Victoria, the second day that's causing you a problem, you've got this timing run where the cool change comes from Adelaide. So you actually end up with spare capacity in Adelaide that can actually flow back on some of those extreme days. So it's a diversification management. But that is really what the retailer's been asked to look at. How do you supply dispatchable load in the state for your portfolio? So that's the market. The question then, what is AGL's position? So we've done exactly the same thing for AGL and put that together. New South Wales, we made no secret when we made the Macquarie acquisition that ideally we probably had just bought Bayswater, but the state government couldn't split it, so we bought Liddell and we didn't need the whole of Liddell. And that's sort of reflected in that chart there. We have more than adequate dispatchable generation in New South Wales to meet our customer commitments. Queensland, the only asset we've had and managed so far is the Yabulu asset. That's going through the sale process now. So we actually don't have any dispatchable generation in Queensland to meet our load requirements. Again, the assumption then will be off contract. And before you panic and think, oh, we've got no cover, we do have a deep liquid contracts book that manages commercially those risks. And one of the interesting things we're introducing in the neg will be how you translate those into demonstrating that you actually have dispatchable capacity supporting those contracts. So the book is managed, but in terms of assets AGL has, we don't have any assets in Queensland. That has a potential opportunity depending on what happens in the Queensland market for AGL going forward. Then we get to the states where you don't have that spare dispatchable capacity in the marketplace. And you see with SA, we actually do have spare within our portfolio for 2019 into the book. Bear in mind that's very line ball to our actual customer load, and the bulk of our customer load now is residential load. So it's actually quite tight. So when people talk about contracting from AGL, for AGL in South Australia, when we look at the commercial and industrial space, we're actually more of a net buyer than using our own portfolio because that's not adequate to grow into the commercial industrial space. So we are a buyer of contracts in South Australia, probably more than a seller normally. And then in Victoria, again, a state that's short, this is the opportunities of providing value in the book here and now because we have plenty of spare dispatchable capacity in the Victorian marketplace, which is covering our portfolio. The interesting thing for us for the development of the NAG is how our contract book is then translated to show dispatchable generation. It's one of the key questions, and how you define those reliability standards, which is one thing that Tim will be working on through the process, and plenty of people in the team will be working on, is how you define reliability so we can actually use this and provide value to this in the book, because that will be the key to making those investments in dispatchable generation. The other one is environmental standard and how you set your emissions targets through the neg. We don't have any great inside information other than what's in the public domain on how the neg works. So if you want more detail, you probably can find this all out yourself. But we've tried to translate our portfolio again for the customers we've actually committed to sell to. So if you look at the neg that's proposed at the moment, they're setting a reliability standard. If you don't meet, the penalty is your loss of your retail license, which is a pretty odd penalty to use. And I think it stems from a lack of desire to put a penalty price for carbon on there. But if you actually look at these bars are here representing, the actual bar at the top is what we've committed. Thank you, Regina. Just get heckled from your own team. The bars here represent the load that we've actually committed to for 2019, so actually contracted for. In terms of volumes, the bulk of that is mass market. So we've taken out the C&I load to show that's our long-term commitment that we have to supply renewable energy certificates to, or energy efficiency to. We've then tried to stack against that our renewables portfolio to say, if we had to use all our renewables portfolio to back the mass market, what our carbon intensity before that portfolio? We've done it both state-based, because we don't know if it's going to be a state-based scheme or a national scheme. On the far right-hand side, it turns to a national scheme. The pink dots are actually your carbon intensity that you supply that domestic base at. Now, although we've got a large coal portfolio, we've actually got a large renewables portfolio. And if they're allocated to our residential customers, we can easily manage those targets, leaving the carbon portfolio to be sold into the marketplace. But we still have to work out how this scheme is going to work and how we, again, translate the contracts that we've sold into efficiencies on those contracts and against customers. And the interesting thing with the discussion with a number of the regulators, AGL, when it contracts, actually contracts with AGL Hydro Partnership. So we might have just double sold all our environmentally clean through the Hydro Partnership on those contracts. So we've actually got to work out how you source what you sell back to a generation facility. That's the neg. The other market change is the change to a 5-minute marketplace. I'm sure you're all familiar, but I'll go through it anyway. The market currently settles on a half-hourly basis. So even though you dispatch the power stations on a 5-minute basis, you average out to the half hour to get the settlement price for a half hour. This has created a huge concern in the market about what they call disorderly bidding. And classic case that was picked on this year was in Queensland, where a generator would drop its load dramatically in the first 5 minutes. The price would go to $14,000. Then they'd ramp up the generation for the rest of the half hour, push the price down incredibly negative to about minus $1,000, but you still get an average price of $2,500 for the half hour, and they've got the generation away. It's called disorderly bidding. So actually, that was a very unique circumstance. Now, a passing comment earlier on, if that's your strategy for gaining earnings, it's not really an investment criteria, is it? It's just a very one-off opportunistic behavior. But this created a lot of concern in the market, and it also was a concern about, did it reward batteries that can provide that instantaneous response to a price signal? So the decisions might be made by the AMC to move to a 5-minute market. They've given us 3 years and 7 months to make that change, which actually, think about the settlement processes and all the things that have to change from meter and settlement. That time frame is required. It's actually a fairly big time frame. But one of the critical things is this is all about managing volatility in a marketplace. Those price spikes, the bit that hurts businesses for not being set properly. So when we looked at it is, how does the market and how does AGL's portfolio respond to these price spikes? Can we manage this change? What we've put up on the left-hand side, and I'll walk through the graph in a little bit detail, is how various asset types respond to a price signal. The purple, actually they're all sort of purplish. The purplish on the left-hand side, the battery, can respond instantaneously to a price signal. It can dispatch straight away and get up there. And that means it's excellent at responding to a price signal. It's there. As soon as it occurs, the battery's providing power into the marketplace. Means it's excellent for this. But what we tend to find with batteries, the main problem in the economics of batteries is not so much the capacity it supplies to the market. That's not that expensive. It's the storage well behind it. And how long can it sustain? So if you've got a short price spike of 10 minutes, brilliant. A battery is superb. If you've got a sustained event over in a couple of hours, you drain your battery. What's worse than that, you drain your battery, you've got to recycle and refill before the next event. Reciprocating engines, Barker Inlet. Why do we go for Barker Inlet? It was basically that ramp profile. Within 5 minutes, you're generating 60% of its capacity. Within 10 minutes, you're fully loaded. Not as good as a battery, not as fast as a battery, but pretty damn fast. You're on to full load in 10 minutes, which is useful. Coal generation. For coal generation, we also read thermal, so Torrens Island as well, thermal generation, its ramp rates. Now this does vary between units, but it's that slower ramp over time. That's for a hot unit, a unit that's actually on, not at full load, how quickly it can pick up the generation. And that's quite key, especially when you look at something like South Australia and Torrens Island. Great if you're not fully running Torrens Island, you ramp over time, perhaps don't catch everything, but you can capture some of it. But if you're actually taking a unit off, and it's not running, 10-hour cold start. So if you've got a price spike, you've missed for 10 hours. So when you think about risk management in the portfolio, when you have a unit you can't start, that's not a very good risk management tool, and stems from a lot of reason why we run Torrens Island when it's probably not economic from a gas perspective to do that. What we've tried to do is translate that into a 5-minute market, because these assets are all there to provide risk instruments to the marketplace. Either we sell them to other wholesale market participants or we use them themselves. So given those ramp profiles, if you have a price event in the market, how well do these assets cover those price events? So we try to use a bit of history by looking at South Australia. We did all the different marketplaces and they weren't particularly different, so we just picked on South Australia. And said for each event, using those ramp profiles, how well did those assets capture those price spikes? Reciprocating engines, because they can come on quickly and stay on for a long time, captured the most. That means they're the best assets providing insurance. It's actually a pretty line ball between thermal that is running and OCGT. And it's one of the reasons why when we looked at Barker's, we moved away from the OCGT technology, because it wasn't effective of capturing those price spikes. These are box and whiskers diagrams, if you understand, but basically that square area is the percentage range of these prices that they managed to capture. And then you've got the tails on there. The battery technology, which is the really interesting one for me, it looks like I'm very, very negative on battery because I'm saying it doesn't capture a hell of a lot. The only reason it doesn't capture a hell of a lot is because of the volume of storage that sits behind the battery. If you build more storage, it just steps up and captures far more. And it will be the almost perfect thing for price spikes in the market when you build large storage behind it, because it can sustain supply into the market over a long term then. That then comes, though, to the cost of that storage, which is the expensive component of a battery. And that's the interesting thing when we look to the future about how soon batteries become economic, because it does provide that fast start response. But at the moment, for the portfolio, we're looking at reciprocating engines are the best technology to provide both a fast response and the sustaining supply to the portfolio to cover both sides and keep the capital costs down in those investments. So that's something on the price changes, on the market rule changes. Then we come on to some of our investments. And Andy talked about, before we put the 90-day plan up, it wasn't like we weren't planning beforehand. And if you actually step back to planning in terms of investment into the power markets, the gas market is problematic. And those problems are now flowing into the power markets. And when you look at making investments in assets, one of the things when you're building a power station, you need to source fuel. So any investment in a gas-fired power station, you wouldn't wish to do unless you were more sure about your fuel sourcing. So underlying a lot of our power investments started off with grid point. Why? First of all, Victoria. If you look at the demand-supply balance in Victoria, it needs BHP Exxon. The market needs it. Without BHP Exxon, there isn't enough gas, even with flows down from Queensland. So AGL's largest gas retail base is in Victoria. We're reliant on BHP Exxon. Just a statement of facts. We can get competing supply in from other states. We can bring gas in from Queensland. But if you move to those markets, that opens up 3 more producers I can buy from into that marketplace. It also builds in a transport cost of shipping gas from Queensland across the network to bring it down. If you look at those 3 producers, and this is stuff you can do yourself, we have Santos. I've got no issues dealing with Santos. They're a great organisation to deal with, but they're not particularly long gas at the moment. Quite the opposite. They're a major buyer of gas at the moment to fill their portfolio. I've got Origin. I love the guys at Origin. Enjoy dealing with them. They're a key competitor from us, and they're not that flexible on providing me gas supply. So I've got Shell. We can deal with Shell. So if you actually look at that upstream, it's not very competitive. It's also incredibly opaque. And this is one of my great frustrations when I started doing gas quite a few years ago is, can't you just tell me what the gas price is? And I always make this comment when I talk to the regulators. You're trying to ask the gas price. We're involved in the gas price every day. We can't fathom a live gas price here and now because the market is so opaque in this marketplace. That's a critical problem, especially when you're trying to supply that gas to supply assets in the power market and respond to the power market. And in terms of efficiency, trade between the two. Now, if you've got a gas assets and you can see value in the power market, do you use your valuable gas or do you supply the gas into the gas market? Without a liquid depot market for gas, that's very, very hard to do an arbitrage. It's inefficient. And it's not just inefficient for AGL. It's inefficient from Australia. It's a wasted opportunity to optimise between the different portfolios. So if you look at these investments, what we're trying to do with Crib Point is bring competing supply first and foremost into the marketplace. And we talk about agile capital. The picture on there is the actual Crib Point jetty. When you think of the investments we need to make Crib Point happen, we'll bring a boat down and we'll tie it up at this jetty. Not heavy capital. We'll probably end up leasing the boat, and we've just issued tenders for that approach. Maybe a 10-year lease, maybe a 15-year lease. We'll wait on the commercials. But if the market changes, it's a boat. It can float away. We can sublease that boat out. It's a light capital investment. The investment on this jetty, when we've finished the investment, it won't look hellishly different. There'll be a few more pipelines that run along there. The major sunk investment actually on Crib Point is not the actual jetty or the port facilities. It's actually the pipeline that will take the gas from Crib Point to Pakenham, which will be a sunk investment. But you actually think about an investment, the level of capital involved in that, for actually fundamentally changing how our gas market works and getting away from this situation where if the short-term international gas price is high, that's what you pay as a buyer. If that goes down and the long-term international price for gas is high, that's what you pay as a customer. You get to break that. And you actually get to create a gas market in Australia that is functioning, not just for AGL. I have a little vision that come 2020, we will be providing prices for the market to provide a liquid, deep trading market for gas, at least in Victoria and hopefully the other states, because that creates efficiency that drives value across AGL's portfolio, across the market, eventually works for customers as well. And this is a reflection on the impact of that dysfunction in the gas market flowing into the power market. I've done this for every state, but on the bottom, the bars here are actually telling you how often gas sets price. And you see it was declining for quite some time because gas was really, really cheap, low marginal cost. It was actually quite low down the bid stack, but we had plenty of completing supply. As coal's disappeared, you can see the level of time, number of times gas is setting price increasing quite dramatically. But with that, the actual price they're setting at has risen. So this high cost of gas and lack of supply is actually driving up quite dramatically the power market as well. So that dysfunction has flowed very, very quickly into our power markets at the same time. So Crib Point comes to assist in both of these and providing gas into the marketplace. Barker Inlet Power Station. It's been announced for some time and we'll be hopefully building fairly soon into the new year, which is excellent. If you actually look back at the slides and what we've been talking about and why we've been looking at these investments, first of all, it's not a large-scale investment. It's not a $3 billion new power station. It's a $295 million new power station. Exceptionally flexible, fast start, responds well in a 5-minute market, but particularly responds well in a market that's heavy with renewables. And if we had taken you downstairs, some of our guys would have talked about the challenges of a portfolio with a high level of wind in and insurance. Because when you have a thermal asset that takes 10 hours to restart, you have to leave those assets running in case the wind drops away. If you can start a power station within 10 minutes, you can forecast wind drops and you can have this up and running in response to very, very quickly, which means you don't have to have thermal plant running, burning gas at a loss to provide risk insurance in your portfolio. Fuel sourcing, why diesel as well as gas? We've seen the volatility in the gas market. Now, over the winter period, we've seen prices well in excess of $20 a gigajoule. If you actually look at the cost of diesel, it will cap that out between $16 and $18 a gigajoule. Still incredibly high, but it allows you to take a few more risks on your fuel sourcing strategy because you know you capped at diesel. You won't be left stranded by a marketplace. And the risk we faced this winter, where we actually even couldn't source the molecules, which actually limited our ability to contract gas in the gas market, but actually contract Torrens as well, because we couldn't source gas. So you know you've got a fallback, and you know you won't have to pay those prices. Also with the distillate, one of the main things about these new power stations are actually the fixed costs you take on. The storage facilities you need to store gas to be used in those peak periods, but the haulage, when you can dual fuel to distillate, you actually don't have to need to commit to large haulage positions, because if you can't access the haulage as available, you can fall back to diesel, again reducing the cost, meaning greater flexibility. And the reciprocating technology, that faster speed, and when I talked about it in the 5 minutes, the ability to capture spikes for insurance is critical for managing the portfolio. Now, we talked about, someone asked a question about investment in these changing markets. Our customers will have peak load in a hot day. Our wind portfolio will vary. These assets add up to make sense to those regardless of the market rules that sit between us and our customers, and they stack based on the flexibility that we build into the portfolio. So when we're looking at those portfolios and how we build the portfolio, we have a lot of conversation about firming cost of wind. Now, before I start, out there in the public, you get a lot of conversation, oh, it's not base load, therefore it's not as good. If you think about AGL's retail book, our customers for some reason go to sleep overnight. They consume less power overnight. And for some reason, they put the air conditioning on in the middle of the day and peak demand in the middle of the day. That isn't baseload power. So if you're thinking about supplying residential customers at the very least, baseload power doesn't cut it. Baseload power needs something else as well. You either need to overbuild it so it can manage the peaks and then run it down overnight, which is increased capital cost, or you need generation as well to stack on the top. So when people talk about baseload power, that needs, I won't call it firming costs, you need shaping cost on top of managing that as well. So please bear in mind when you look at like for like in this situation, because you're not trying to get it to baseload. You're trying to get it to a product you can supply your customer, which is critical. But when we look at our portfolio and how we firm renewables within that portfolio, the first starting point is diversity. Now, Australia's got difficulties because it's a very, very long, skinny network. And if you compare it to somewhere like Europe, that's a very, very meshed network, it's easier to build that diversity of renewables in there. But we do still have diversity in our renewables portfolio, and that's what we look at when we look at renewable sites. I've got an automatic no if someone asks me to build a solar project in Queensland. I've got an automatic no if someone says, oh, do you need wind in South Australia? Wind in Queensland. Haven't got much of that. Diversifies the portfolio, diversifies the risk. Wind in South Australia, in New South Wales. There has been wind built there. It's not a high penetration level. AGL doesn't have much. Diversifies away. Solar, New South Wales. Still low penetration of solar. Solar and Vic still low penetration. Wind in Victoria, a bit line ball. Will really depend on the cost of the site. But that diversification isn't just a cost. It's about risk management. The more diverse those fuels are in your portfolio, the better the portfolio is and the more reliable it is. So that's the starting point. But that's also linked to the penetration of those assets in each state. As I said, solar in Queensland, it just doesn't work now. It's a waste product until you get storage to go with it. Equally, wind in South Australia. There's no point building more wind in South Australia unless you can store it because it will go to waste. So you actually have to look at the penetration of each renewable in each state to decide where you're going to put your renewables portfolio to get the best out of it. But we don't instantly look at a renewables project and say we need to build something to support that. We've got an existing portfolio of assets and we'll leverage off those assets to actually manage that firming cost. And that includes our coal assets, but our gas assets and our hydro assets. Even then we don't instantly go, now we need to build something, because there's other assets in the marketplace. We have contracts with practically every player in this market who's a generator for various services, including insurance and firming products in those marketplaces. You go to that first, and then you get to the cost of actually building new generation assets. And the interesting thing will be for this is that declining cost for batteries over the years to provide that extra storage. That means the best wind resource in Australia, which is South Australia, can be better utilised because you can store the energy. Which goes on to this slide, which is batteries. And batteries are the big changer that are coming but are not there yet. We just put an example up. It's a fairly obvious example of the North Brown Hill wind farm. The wind resource there is shown in blue, but the pink line is actually showing what we can physically get out onto the system due to constraints. That is wasted energy. That's energy that's going to be replaced by something else, probably gas that's highly valuable. And this is the opportunity for batteries to come and provide that storage of that waste energy and provide it back at the market when the market needs it. But it's also that peak capacity insurance that you can see from the fast starter batteries that's coming. The grid scale batteries can respond to that market at speed. Frequency control that's provided by existing thermal plant. Synthetic frequency control from battery, that's technology they can provide and we have to build markets for. The price arbitrage. When North Brown Hill is constrained like that, the energy at that is zero value. Shifting that to a period that is seeing a $100 price, a $200 price, or even a $14,000 price provides that opportunity for arbitrage. Batteries are superb for this market. It's a matter of cost. And what we're seeing at the moment with battery technology is that the batteries that are all getting installed are all subsidized from other means to get them into the marketplace. That will change. And it'll be a game changer that's probably not built out of requirements for the energy market so much as EVs that actually reduces the cost of battery technology and actually gets the volume storage behind them economic to build at scale. But it's coming. Then finally, the other component that's also going to be changing AGL's wholesale portfolio as we look forward, and it goes on to the new energy and the personalised retailer space, is how do customers invest in their assets in their home and how do we utilise them? We've already had peer-to-peer trading, we've got virtual solar. But that concept that we get from a virtual power station where end-use customers are investing in assets in their home. Now they're installing batteries, they're installing solar panels. We need the smarts because that capital is wasted if it's just supplying the home. The opportunity to provide grid services is huge. So how do we get that smarts into the home? And it gets to that point Andy's making about customer advocacy, to actually get customers to cede control to a company like AGL. Yes, there's going to be an economic equation. How much do we pay them for those services? But do they trust us to manage their energy assets for them and provide services to their household, to their neighbours, but also to the broader grid? And if you look what we're trying to do with the virtual power station in South Australia, it's a battery project to store that waste, renewables project that's not just coming from the solar panel on the roof, but it's also coming from the grid. But then provide those services back to the market on days like this when it's 40 degrees in Adelaide and the market is crying out to meet air conditioning load. This technology will be driven through those automation, can't say the word, and that's going to be critical how we orchestrate those assets with our larger portfolio and bring them in. And it's colouring our view of how we invest and what we invest in the wholesale portfolio, because these changes are coming. So if you actually look at, to conclude with this, our portfolio is actually well positioned for the market rule changes we're seeing. We see the NEG as an opportunity to get stability in the policy space, and we're very, very supportive of getting the NEG in. We need to work on the design of the NEG to make sure it works with our market structures. But there's a consultation process going on, and we believe that can be achieved. The projects we're investing in are those agile capital projects. What are the projects we need that are critical to support the portfolio without over-investing? And are they backed by our customers? Do they support what we're trying to do on our customer front? And all those projects do. But also, in looking at those investments, what happens if the market changes? What happens when batteries do drop in cost? And they will. We don't want to have installed 2,000 megawatts of new thermal power station and all of a sudden to discover batteries are the latest, greatest thing and wipe the economics out. So it's making sure the investments fit our portfolio, but we're not overextending in those spaces. So our portfolio is prepared for the longer term. And on that, I'll wrap up and over to the floor for questions.
So, it's not on it? Okay. Yeah, Richard, it's Nick Burns from UBS. Just a question on the economics of Crib Point. A couple of data points out at the moment. You've seen spot LNG prices in Asia pretty high. Oil prices have rallied. So I guess the inference there is that bringing in LNG may not be that cheap. We've also seen today, I think ACCC report talking about recent offerings to customers in the $8 to $12 a gigajoule range. So I guess the two-part question. First of all, how confident are you that the economics of Crib Point will actually stack up when you bring it online? And secondly, have you looked to mitigate your exposure there by introducing partners or other off-takers into that project?
Okay. The project is still going through feasibility. We've launched a tender to see gas supply contracts. The actual flexibility of that project, if you just ran gas all the time, I'm looking Phaedra here, so she's going to do the, if I'm wrong, 150 petajoules per annum if you just ran boats constantly through it. 140. Round down to scenarios with 50 petajoules per annum, which would probably be a winter loading. So some of the economics around Crib Point, not just the pure gas price, but the arbitrage between Northern Hemisphere summers versus our winters and bringing gas through. Building flexibility into the contracts. We have been very active in the market and talking to other participants about the economics of that and working through. Between now and when we actually come to FID on that project, the oil price will move. And I'm struggling to predict the power prices, and that's meant to be my expertise, so I'm not going to start predicting oil prices. We will see through the tender process how they stack. We're still reasonably confident of the economics and how we can utilise that within the portfolio. Because I keep on going back to that competition in the marketplace because it's actually quite critical. Just because people can see that you can get gas out of the ground in Queensland at sub $12 a gigajoule, probably $7, $8 a gigajoule, you've still got to transport it to Victoria. You've still got to shape it for customers because that's production well. And then you've still got to negotiate with one of the lovely suppliers in Australia. And all those things add to cost. The other side on the ACCC report, I do struggle with some of the prices they've put in there. I find it very, very hard to believe that prices that they think are net back would actually encourage anyone to drill a well in Queensland. I just think they're fundamentally too low from where we're seeing. So it's an unusual number. So I don't a lot of stock from their dollars per gigajoule. But definitely what we're looking at, the actual cost of drilling wells, especially as we move forward, and the actual genuine shortage of economic reserves in Australia to be brought on as we post to 2020. This is as much about as insurance in the portfolio as anything as well. You know, we look at the tightening reserves, unless more reserves are brought on, and we've seen the latest Shell announcements, and obviously Exxon managed to magically find some reserves, which we all knew about, but chose a particular time to announce it. You know, those are all things designed to colour investment decisions. But we still think it stacks. Ian goes first. Oh, I'm sorry. You cut in then, Ian.
Just a couple of questions. In terms of, very briefly, the technology costs for the 5-minute switchover, how much are you guys going to have to spend to actually do it? Because I presume you're not going to get really any return on it.
Can I not quote a number? I know we put in one of our submissions. It is serious. It's a large investment.
Can you do anything else to improve the system when you have to do this to get some value?
It will be a cost borne by all market participants. And it's not a smaller cost. The value of incumbency, you've got a large base to spread that over. I personally don't believe that was a necessary market rule change. AGL was a little bit ambivalent to it because it supports battery technology coming in, which is great, but it devalues a lot of the OCGT assets that have invested in the marketplace. So when they talk about long-term greater efficiency in the market, you're talking about very, very long range for what is actually quite an expensive process to go through. But it's here, we're a participant in the market. Is it a game changer for costs for AGL? No. It might make some of the smaller guys find it more difficult to manage their books, which is not good. But it's something we'll manage. I know I think we did put in one of the papers what we thought it would cost, but I can't remember the number off my top of my head, and I don't want to make it up.
Look, just on a couple other on South Australia, you talk about Torrens and the Barker Inlet. The open question is, given you talk about synchronous generation and all of this, is why haven't you shut down the whole of Torrens Island? Because I think you describe it as a very old lady, and you expand that even further. And secondly, is you show us those wind farms and you're saying energy's wasted or energy's a waste product. How far away is the economics of a battery at your North Brown wind farm actually there to make sense? What sort of price decline in batteries before they become real alternate investment decisions? Okay,
just to clarify, Andy was old lady, Doug was retirement home. I never said a word. So it's those two. Torrens Bay has still got good shelf life left, and the market in South Australia needs Torrens Bay. The economics of Barker Inlet economics stood not on the power market but on the gas market. It's about getting greater efficiencies in our portfolio so we burn less. So yes, it will earn cap premium and energy premium, but it was reducing the cost of burning gas through Torrens, not necessarily Torrens A, but Torrens B as well. We sit there on a very windy day with probably 2 Torrens B units on running 40 megawatts because they're minimum load, because we don't want to take them off, because if we take them off, it's a long time to start. That's probably the most flexible plant in South Australia. The thing I find amusing with South Australia is the old lady, quote a term, is actually far more flexible than the Pelican Point that has a turn down to about 120 megawatts. So we can actually turn down Torrens very, very low and have that insurance our portfolio to ramp up, which minimises our gas burn. Barker just takes that to the next level because we can actually take units off, keep them hot, start Barker Inlet, bring a Torrens B unit on, that takes the slack, manages through. So it's a very, very flexible plant. So what we actually see is we'll be running Barker ahead of Torrens B units as well. So it will see a drop down in generation for B. However, having said that, B is needed for system security issues in South Australia, inertia issues, voltage support issues. So taking B totally offline is not tenable at the moment. As we see batteries come in, providing some of those services, then you'll see B used less and less in the marketplace. It will be a long while before there's enough secure capacity in South Australia to remove B from the market, but it's coming. I mean, the price signals, the investments are being made. That's competition working, because that will be what's driving B slowly out of the market and getting replaced in the marketplace over time. As for a battery, when the battery technologies are economic, that's is it 5 years or is it 10 years? And that's a critical question for the market. I actually don't know the answer. We see a lot of information come through, and I do actually think it's not the power industry that will actually drive that. It will be the EV industry, because that's driving the innovation and the cost in those marketplaces. They are not economic yet, and we notice in the 90-day plan we put that battery at the back end of phase 3, because that's when we feel that that's when they have the most potential becoming the truly economic in that time frame. But it's still an open question as to when they actually get the economics right on them. They're not quite there yet, but they're coming. Sorry.
John Hergy, Deutsche Bank. Richard, back on Crib Point again, if I could. How are you thinking about the inventory levels with the volatility of the oil, and you'll have gas come in and you'll have some in storage, presumably. Mm-hmm. How are you thinking about the value of that? Because it could affect your P&L quite dramatically if the oil price moves very significantly.
Yes, I'm getting used to this oil market slowly but surely. You know, it's one area of expertise we're growing quite significantly within my team to get our heads around how we manage that. First phase is get the tender approach to see the longer term quotes for gas to come into the portfolio. But very critical a bit in that tender is the flexibility we're trying to build into those contracts. The ability to take cargoes, trade cargoes, move cargoes around. So we're taking a very flexible approach to supply into that. Bring it into Crib Point with storage and being able to hold at Crib Point, but then push to Iona as well, means we can take that opportunity of low points in the market when we perhaps don't need it, but can store it and bring it back. So we do see quite a bit of value in that. So it's quite critical in the view of carrying inventories on that in the value of the project. But before we can really drive the economics of that, and it also before we start talking to other parties about offtakes for that, is actually getting that first stage of tenders through into the portfolio, so we know the type of things we're looking for in the contracts and we can achieve into the portfolio. It is a very, very flexible asset, and I keep on saying the word flexible. It is absolutely critical in this market for volatility in the gas market, volatility in the power market, and great we're taking volatility in the oil market, but it provides opportunity to play between all those fuels and actually drive value into the portfolio. Because I think very much in Australia we have a lot of missing value by the lack of liquidity, definitely in the gas market, and that's what this can bring through.